Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah. Over the next 25 minutes, we'll talk about a few facets about the mutual fund space. Some discussions around a key Flexicap plan and whether Flexicaps are the best products to invest into currently or are there better options within the equity side. So our guest who will join in a bit later on the show, Kirtan Shah, will be talking about that. We'll also talk about whether very large funds do they necessarily restrict outperformance on the fund side? So I have a conversation about that as well. But to kickstart the show, we will talk about a brand new offering in the mutual fund space. ICICI Prudential is coming out with the nifty lower wall 30 ETF fund of fund. Now, you would ask what this is, what kind of investors would this be suited to? What about the timing of the same fund? Remember, the advisor who will come in will give his view. But first, let's get in the head of product and strategy at ICICI Prudential, Chintan Hariya, to come in and talk about what is this product all about. And again, the questions that I said that we'll ask him, let's just start asking him that. Chintan, good having you. Thanks so much for joining in. Appreciate you taking the time out. Hope all is safe.
Yeah, thanks, Neeraj. Good afternoon.
Good afternoon, Chintan. So, Chintan, tell us about this. What is this concept of the low wall 30 ETF fund of fund?
Yeah, so the name is long, but the concept is very simple. It is a fund of fund offering on one of our ETFs. So if we see what has happened in the last 3.5 years, we've seen a growing trend among investors for getting invested in smart beta ETF strategies. So passive funds itself, which is essentially ETFs and index funds, are growing in popularity. And within passive funds, we have seen a growing trend of HNIs moving towards smart beta strategies. And within the smart beta strategy, what is a smart beta? The selection of stocks is based on a particular factor. We felt that smart beta strategies around low volatility are a good fit for the long-term wealth creation journey of any investor. So that's where about 3.5 years back, we had launched the Nifty Low Vol 30 ETF. And as you all know, ETF can be invested by those who have a demat account and a trading account. But a large section of Indians do not invest necessarily to the demat and trading account and want to invest in a smart beta strategy. So for those investors, we're bringing out the Nifty Low Vol 30 ETF fund of fund, which is essentially a wrapper or a product which invests ultimately in the ETF itself. So for a simple investor to invest in a systematic investment plan or a lump sum method without having the demat or trading account, the fund of fund is a route which they can take. And the NFO is opening on 23rd of March and closing on 6th of April. The concept of low wall, etc., of course, as we move along, we'll come to. But this is simply bringing in simplicity for those who are wanting to invest in smart beta strategies in the passive side through the fund of fund route, while keeping the taxation same as equity taxation.
Okay. So essentially, this wrapper, as you call it, will mirror the returns of the underlying ETF. Am I correct?
Yeah, so the idea is that the FOF is investing in the ETF. So whatever returns the ETF gets, that similar return you should get in the fund of fund as well. There are minor tracking errors which come in, but as an overall basket, ultimately it is, you're right, it is going to track the underlying index through the ETF route.
Okay. And therefore, Chintan, tell us a bit about the ETF itself. Why is it that an investor should via the ETF route, or let's assume because you've revamped this product from a perspective of person who doesn't have a demat account, so then via this route, either of the two routes. Let's say I have a demat account and I'm happy doing it via the ETF route straight. But the question is, why should somebody believe that this underlying that you're speaking about has merit in investing in it?
Yeah, so it's the underlying which is important. Whether you invest through the ETF route or the fund of fund, it really is up to your choice. And it's basically bringing in the convenience of whichever platform you want to invest in. The whole idea of the concept of low wall itself is very appealing for two reasons. One is in life in general, we like stability and in every aspect of life. Similarly, if in stocks as well or in equities, if we can choose 30 stable stocks, which is 30 stocks gives us good diversification, and the 30 stocks on low volatility are chosen out of a universe of the top 100 stocks. So the product is very simple. The index provider, which is the NSE indices, has a methodology based on which the top 100 stocks are the universe. Out of the top 100 stocks, the 30 stocks chosen on the basis of lowest volatility of the last 1 year are part of the index. And as an investor, you will get a representation of those 30 stocks. And the stock selection as well as the weightages are on the basis of low volatility. So the stock which is lowest on volatility gets the highest weightage. So not just the selection, but also the weightage is basis low volatility. Now the whole concept of low volatility itself, just to elaborate, is a very simple concept. We all know that risk adjusted returns is something which international investors look upon a lot. And even in India, it is catching up ground among investors, and we're seeing a large set of Indian investors looking at low vol 30 ETF because on a risk adjusted returns parameter, it does provide a better return. And low vol means stocks which are more stable. Now, in the past 15 years of my working career in the mutual fund industry, I've seen enough people, because of the volatility in the market, come in at the wrong time, going out at the wrong time. And March 2020 was a classic example. But because the volatility increased, people ran away. And it is trying to avoid that greed and fear. If you have a set of stocks which are more stable, hopefully the investors remain invested for the longer run and participate in the long-term wealth creation journey of equities. The risks of equities remain in any equity product, and it will also remain in this product. But at least the stock selection is on the basis of those stocks which are lower on volatility, so which are more stable, and hopefully the investors can participate in it for the longer run.
Um, how one against benchmarks has this product been able to do well across time periods? Because while your ETF was in, I think in you said 3.5 years ago, which means maybe 2017 onwards, but typically a product like this did you back test it then, and therefore what has it done in periods of high volatility, low volatility, and what has it done in its existence, so to say, since 2017? Chintan, any remarks there?
Yeah. So the Nifty Low Vol 30 index data is pretty much available, which is being tracked by the ETF. It's pretty much available since 2005. And if we look at it over the last, the data since 2008, which we saw, even in years which have seen significant outperformance of the market itself, like 2009 or 2014 or 2017, this product has been able to deliver equivalent or better returns than the market, while the volatility is lesser. The past returns may or may not obviously recur in the future, but the concept of low volatility in long run, 5-year, 10-year period, has been able to deliver a better experience than the relevant broad market indices. At least that's what the index data is suggesting. And in the last 3.5 years, if you look at it from the ETF perspective, since it's been in existence, the very fact that it has been able to generate stable returns, positive returns for the investors in the 3.5 year period at a time when the markets itself has been very narrow, most investors have been pretty happy with the way it has been able to perform in these last 3 years as well. And just as a data point, in the last 13 calendar years, running up to 2020, 8 out of the 13 calendar years, the benchmark was beaten by this particular index. And the balance years also, the difference was not much in terms of the performance. So I think from a strike rate perspective, this index has done well. And as you would know, that no particular factor can work in all market conditions. So if like last 6 months, if it's a high beta strategy which has worked better because there has been a significant change in the market direction, then you will find that this product may underperform a high beta strategy when the high beta does well. But that's not the point. The point is an investor's allocation into a particular product will be basis an overall asset allocation which the investor will come to. And we firmly believe that low vol as a strategy for the long run does fit an investor's portfolio, much like the dynamic asset allocation funds fit an investor's portfolio for the long run.
Chintan, pray tell me, would you say that this product would be, this product would be terrific for somebody who is seeking a lot more stability, but for somebody who is a lot more adventurous and willing to take higher risks, would this product pale in comparison to maybe some of the others? I'm just trying to understand that maybe it's fantastic for people who want stability. Could there be other products which could be more suited for somebody who doesn't mind that higher element of risk, as long as she or he is wanting to chase higher returns?
So in the last 3 years, 5 years, 7 years, 10 years data that we've seen, compared to most indices, this index has been able to deliver a return.
Sorry, Chintan, I'm not quite able to get your audio.
Okay, can you hear me now?
Much better.
Okay, maybe the network did its trick on me. My apologies for that. So essentially, if we see in the last 1 year, 3 year, 5 year, 7 year data, if we look at it, choosing a particular index out of the many options that an investor has is always a tricky part. And you can always say in hindsight that a particular index did well in 1 year and you could have been invested in that. But at a portfolio approach, if I see 3 years, 5 years, 7 years, 10 years, this index has been able to deliver a better return compared to the other broad market indices, especially if we adjust it for risk. And so when you mentioned about adventurous investors, of course, adventurous investors 1 year back when we had a view that commodities is going to do well and we launched the commodities fund on the active side, no doubt commodities fund has given a much better return compared to the low 130. So if the investor does have the ability to pick the right high beta index or the strategy at the right time, yes, the investor can choose that. But I think very few investors have that ability. And that's where, as a longer term stable allocation, this fits in well. From a overall 100 rupees, if I say 10 to 15 rupees in this particular strategy won't hurt the investor, because I know that most investors wouldn't want to have more than 20-30% in high beta strategies. So I'm saying the rest 70% can be well established between this and dynamic asset allocation.
Okay. And Chintan, one final question really. So it sounds fairly good, right? The performance has been strong. Everything looks okay. What are the risks to this?
Yeah, so one of the risks which you mentioned, of course, is that there will be times, shorter time periods where the market may change direction in favor of high beta stocks, and those high beta stocks may outperform, which may bring a marginal underperformance of this particular portfolio versus the broad market indices. But in the long run, like I said, if we keep invested, I think this has a place as an asset allocation for all the investors in the fully invested equity category, and that's where the ETF itself of ours, which was a sub 10 crore category for us about 3 years back, is now a 250 crore plus category. So we are seeing interest among HNIs, and that's where we are bringing the fund of fund to take it to the larger set of audience who are looking to invest in fully invested equity funds. Apart from this, of course, the necessary risk of equity lies. So if the entire market itself falls, then this being equity, it will fall. So this should suit an equity allocation. Let me reiterate, it's an equity allocation product. It does not take cash calls. It's not going to reduce its equity when the market goes up. So if your overall asset allocation allows you to invest in equity, this should be a good product, a good fit from the long-term wealth creation perspective.
Okay, Chintan, we'll leave it at that. Thank you so much for taking the time out and giving us a small explanation of this new offering, and all the best to you and ICICI Group for this NFO.
Thanks as always, Neeraj, for all your support. Thank you.
Well, pleasure is ours. It's good for all our viewers to get a sense of what the new products are all about. So thanks for that. Well, viewers, that's Chintan Haria giving us his sense of what this product is all about. Chintan, thank you. Thank you for joining in today. So let's thank Chintan. And now, now that we've understood what this product was about, let's try and get in. Kirtan Shah, again, needs no introduction, has been on the show a number of times to tell us, well, to start off with his view on this product, and of course, then extend the conversation to a couple of other facets that he wanted to speak to him about. Kirtan, good having you. It's been a while, but thank you so much for joining in today. Hope all is safe.
Thank you so much for having me on the show. All good at my end, and hope the same at your end, Neeraj.
Yeah, all well, all well. Can you talk about this? Yes, can you talk about this NFO?
Look, this is not an NFO in that sense, in my opinion, is because there is already a fund which is existing in the market on which this fund of fund is coming ahead. So this should not be looked at as a common or a denominated NFO like any other NFO which is coming out in the market. Now, predominantly, while we are trying to look at the ICICI Nifty low volatility 30 ETF, look, the index has been in existence for 4 years. The ETF has been in existence for 3.5 years. But the index, because it's a smart play, it has been reconstituted back to 2005. Now, if somebody like me has to look at this product, of course, like Chintan also said, this is meant to make sure that investors who are looking at low volatility are the ones who come in this product. So if you have to look at this particular product, I would look at it in three brackets. The first is, has the index in itself on which the ETF or the FOF is going to be based, has that performed well since 2005 or not? And because this is a low volatility product, has it been able to protect the downside, which to a greater extent is the appeal for which people are going for this product? And very importantly, because it's an ETF, how does the tracking error of the fund perform? So if you look at all of three data, I think this is a good fund. And let me give you some stats and data points. So while we looked at the reconstituted index from 2005, we saw a couple of areas where the Nifty fell. So let's say 2008 when the Nifty fell, calendar year 2008 by 53.1%, This particular product fell only 42.3% on an index level. Similarly, in 2011, when the Nifty fell 24.9, this product fell only 12%. And in 2015, when Nifty fell 1.3% calendar year, this product outperformed with a positive 9.8% return. So does the index really protect downside? The answer is yes. The another answer to look at is, can the index also outperform in good times? So if you look at 2009, where calendar year Nifty 100 gave 84.9% return, this product gave 92.9, right? And similarly, there are multiple instances that I can share where this product has also done well while the markets are also going up. So does it protect the downside and also perform well when the markets are going up? The answer is yes. Point number one. Point number two, I think if you look at it from a tracking error point of view, look, this product has given a tracking error anywhere in the range of 0.3 to 0.6%, because this is quarterly rebalancing and there is some buying selling that will keep happening. So from that perspective, if this is going to be quarterly rebalanced, I think a 0.3 to 0.5% or 0.6% of tracking error is good. So overall, looking at the last 16 years, Neeraj, the returns on this particular product has been 8.4% CAGR versus Nifty 100 of 14.8. That has come along with lower volatility. So the standard deviation of this product is 18 versus 22 on Nifty 100. And also it protects the max drawdown from a financial year point of view. When Nifty, this index that we are talking about, had the maximum drawdown of 49%, whereas the Nifty 100 had a drawdown of 61%. So looking at all of these three things, I think the index is really meant for somebody who wants to take low volatility. And I don't see a reason why this should not be a fit for somebody who's looking at low volatile investment in their portfolio.
No, so let me ask you a counter question, Chintan. Kirtan, everything seems to be okay with this, right? You're saying that it's underperformed in years of downturn, it's outperformed at periods of upsides as well. So if everything is right, for what kind of investors is this product not suitable?
So answering that question very straightforward. Look, a lot of us who have a higher risk appetite, who are basically looking at a very significant alpha over the index, may not really be happy with this product as such. Is because there are multiple instances where the product has really underperformed the market. So if you look at 2007, where the bulls were really riding, the Nifty 100 gave 59.5% return, but this index gave only 31.5% return and it underperformed 28% in terms of alpha, right? So the point that I'm trying to make is that probably when momentum stocks are supposed to move in a bull market, in a liquidity driven market, this definitely as a product will underperform, or I would rather say this is expected to underperform, right? So this is not meant for people, in my opinion, who are looking at significant alpha over the index. But having said that, over a period of time, I think given the last 16 years of data that we look at, this fund is still very comfortably with a lower volatility, also able to outperform the index very well. So I think very adventurous investors, this may not fit, but this can be a good fit for overall almost all investors, in my opinion.
Okay, fair call. Kirtan, thanks for that. So that's the update and a non-biased view on the FOF. Maybe not strictly an NFO as he said, because the underlying has been around for a while, and this is only if you don't have a demat account that you can probably opt for this. Otherwise, you could have for the last 3 years anyways opted for this. Okay, but Kirtan, let me ask you, in the current juncture, in the scheme of things that exist, what is the product that you believe investors should opt for? I mean, are you very keen recommending a Flexicap offering? Are you looking at a mid cap or a small cap offering? Why that category, and then which fund within that category?
So Neeraj, I think for a lot of us as retail investors who probably would not have a lot of understanding and cannot do the cherry picking of which market capitalization will work in which business economic cycle, I think Flexicap, in my opinion, fits the right in that sense, where you leave it to the fund manager to make the calls on her own, and let the fund manager decide how much allocation should be given to large caps or small caps or mid caps. I think so. For somebody who's not really into fund management, understanding economic cycles and which market cap will really work, should definitely go ahead and settle for a Flexicap fund. And in my opinion, if you really ask my pick, I think Parag Parekh Flexicap fund is a fund that we've been recommending to our clients over the last half a decade. I think this fund really has done well in the past, and we feel that it will continue to do well. On multiple aspects, we think that the Parag Parekh fund will end up doing well. So let me touch base on the softer aspects first, Niraj. I think there are two softer aspects that I would like to highlight. First, look, this entire AMC has only one equity scheme that it's really been focusing on and putting all the heart, sweat, and energy in it, right? They've just come out with an ELSS fund, right? But over there also, if you look at the portfolio, except the international exposure, the portfolio is almost the same. So I think the entire AMC is focused and concentrated only on one product, which is a good sign in our opinion. Also, if you look at it from the other perspective, I think the fund itself has skin in the game. So if you look at the key managerial people in the fund, they have close to 188 odd crore rupee worth of their own money invested in the fund. In fact, their CIO has close to 20 odd crore invested in the same fund. I think so the softer aspect, the key managerial people have skin in the game. Their concentration is completely on this particular product, and I think on the softer aspect, that is something that we like. Now, because we feel that the markets are probably richly valued at this point in time, you have FY23 earnings that you factored in. I think risk management plays a very important role in our opinion while we select or end up selecting funds right now. And the most important thing that we really want to understand or work on is diversification. Now, this fund not only brings a local diversification, but it also brings a global diversification. So this particular fund typically is investing 65% of its money in domestic equity and roughly close to 35% in international equity. Currently, that we speak from the latest fact sheet that we have, close to 29% of the investments is globally diversified, specifically in the US tech stocks. Now, what that does is brings in diversification and reduces the correlationship. So if you look at some correlation data, so let's say Nifty 500 total return index, and if you look at a NASDAQ, they are only correlated by 0.18%. I think that really, to a greater sense, reduces risk in the portfolio, because the diversification is not just local, but it's global. Of course, the most important point to be discussed here, Neeraj, is that if you are doing global diversification, is the fund taking currency risk? As far as we understand, and the detailed understanding that we have about the product, close to 80-90% of the portfolio is generally currency hedged. So they work in the futures market and hedge the currency. But because the Indian currency typically depreciates to the US dollar, right, there is always that slight advantage that the fund has with the rupee depreciation. So if you look at it from that sense, the rupee depreciation of the unhedged currency exposure typically takes care of some portion of the TER of the fund. So the TER of the fund ideally is slightly lower in the real sense, is because some part of the TER is earned through the currency depreciation. Having said that, most part of the currency risk is typically hedged, and that's how it takes care. One last point that I would really want to make here is looking at the past performance, Neeraj. Right? If you look at this fund since its inception on a 3-year rolling basis, there has been not one single period where the fund has given negative return. The minimum return that the fund has given is 0.07% versus the Flexicap category, which has a -8% kind of a return, right? And also, if you look at it from a risk-adjusted basis, this fund has given a 6.5% alpha versus 0.15% alpha on Flexicap category generally. And the drawdown of this fund is only 41 versus the category average of 95. So I think this is, in our opinion, a brilliant product to be invested in right now. Not just looking at the past performance, but looking at the current exposure of the fund as well.
Any risks to this fund at all, Kirtan? I mean, does it have any chinks in the armor?
Yeah, so ideally, if you look at it, a larger, performance of this fund has been driven by the international exposure,
International
right?
stocks.
So if dollar moves inversely, the 10-15% unhedged might probably not work in the favor, and probably because this has a larger Nasdaq exposure to the global equity. I think the technology space sector exposure of this fund is slightly higher. And if that does not work, probably this fund might underperform much.
Got it. Okay, Kirtan, one final question really, and that is on this very interesting data around or this belief that funds with a higher corpus typically tend to underperform. It's a belief that is seeped into a number of people's minds that, okay, let's not look at a fund which has got multiple thousand crores of AUM because the size will hamper its ability to perform. Any thoughts, any research that you have out here, and any anecdotal evidence which suggests to the contrary or affirms the same?
So Neeraj, look, identifying this has become very difficult, and I'll tell you why. Look, over the last 3 years, SEBI's changed categorization rules because of which the schemes have changed uh, uh, the stocks in which that they've invested aggressively. Also, what has happened is, while we were looking at this particular data, right, there is not a lot of data available around the rolling return because of the change in the SEBI categorization rule, right? But having said that, there is some data that I can present to you. So what we did was we looked at the top three or the highest AUM funds, and we looked at the three funds which have generated the highest returns, right? And we looked at that in the large cap space, multi cap space, mid cap space, and small cap space. Now, what we realized is while we looked at the large cap and the multi cap space, we understood that the AUM had very little or no correlation to the fund's performance, right? So we looked at the 1 year data, the 3 year data, and we found out that the funds which were generating the highest return versus the fund which had the highest AUM, there was no real direct correlation. And that is what lends us to believe a little in the hindsight that probably funds which have the freedom to invest in larger caps probably might not have this problem of the AUM increasing, and because of which managing it becoming a little difficult. But while we did the same study on the mid cap and the small cap space, we definitely understood that there was some element where the AUM was playing a role. So we did that same data where we looked at the top three AUM funds, and we looked at the top three return generating funds in the mid cap and the small cap space. And we realized that definitely AUM has a role to play here, because there was a significant difference in the performance of schemes which performed well over the last 3 years versus the schemes which had higher AUM. And the schemes which had lower AUM had significant alpha over schemes that had higher AUM. But having said this, Neeraj, one disclaimer. Look, because schemes have changed categorization, and hence rolling return data was slightly difficult. This may look slightly premature, but whatever little evidence on the research that we have shows the large cap, multi cap may not have a problem with increase in AUM, but mid cap, small caps should have some problem in managing those assets because of liquidity available, right? And hence that should be one component that you take into consideration while you look at mid cap and small cap funds.
Okay, Kirtan, we'll leave it at that. Thank you so much for taking the time out and being with us today and giving us your thoughts.
Thank you for having me on the show, Neeraj.
Pleasure is ours. Viewers, there is a point or two that you've got to keep in mind. As Jack Bogle famously says, that if you look at mutual funds over a really long history, and he was talking about the US fund industry, which is, of course, a much longer and richer history than the Indians, that typically funds which tend to perform really well for a period of 10 years might come out and underperform in the next 10. So is there a logic and a science behind a fund continue to perform for 10, 15, 20 years? Maybe not. And as Kirtan said, that maybe there is some anecdotal evidence which suggests that in the case of mid cap or small cap funds, size would matter, but it is not a concrete evidence. So I would reckon that if you do not have the answers to your fund selection and you are dithering because of the size of the fund, best to speak to an advisor who might look at the fund from a lens of who the fund manager is, what the track record is, what are the expense ratios, what is the risk factor out there, Sharpe ratios and some of the others, and then give you the right advice. So please take that into account. Do not make the size of the fund the sole reason for either choosing to invest or not choosing to invest in that fund. I hope this show was useful. I hope you got a couple of investing ideas in mutual funds. Keep on writing to us if you want to hear more about some specific issues. We'll be happy to answer some of them on the shows. For now, stay safe, and thanks so much for tuning into the Mutual Fund Show.